Hello and welcome to this week's edition of Econoday Unplugged on Tuesday, the 28th of July 2020. Mark Pender is stateside and I'm Jeremy Hawkins here in London. The dollar is under pressure. Yesterday, the trade-weighted index touched a two-year low, while at the same time, gold prices climbed to fresh record peaks. Already high and in too many states still rising, new COVID-19 cases in the US contrast with, at least for now, a much healthier picture in Europe and Asia. And combined with the promise of unlimited quantitative easing from the Fed, rapidly deteriorating US-China relations, and doubts about the prospects for a new stimulus package from Washington seem to be weighing heavily on the greenback. Over the next few days, we'll get the first look at just how badly the coronavirus has hit the US and the European economies with the release of flash estimates of second quarter GDP. These will inevitably look very ugly. More up to date, there's also a number of important July data reports to contemplate as well. All of which, of course, means there'll be plenty to talk about at the FOMC meeting, which kicks off today. Policy-wise, both the Bank of Japan and the ECB have already opted to do nothing this month. But Mark, what do you think that Mr. Powell and co will have to say?
Well, I think they're going to have to address immediate conditions, or in this case, the high level of infections here in the U.S. and less so on what happened in the second quarter, and I think more so what's happening or what happened in July. We had a little bit of a taste of this, of what we can expect in this. These are the consumer confidence and consumer sentiment numbers. These are surveys that are done during the month for the ongoing month. And they both, as well as business, similar business surveys, expectations are going down. It's not usually that way. Current conditions now are better than expectations, which suggests that the infection rates there was an assumption that they would improve, and now that assumption seems to be uncertain. And if there is going to be a second step downward in the economy, that would be its own second wave outside of the infection rate. So it's a difficult position for the Federal Reserve to be in, since they've already pretty much played all their cards.
Do you think part of what they may or may not do will be dependent upon what happens with this package, which they seem to be tossing around the Congress at the moment?
Well, they'll certainly be calling for a significant fiscal stimulus, as they have been since they really played their own cards, the Fed, back in March, that far ago, when they committed to unlimited QE. All along, almost the first thing they say is that monetary policy is pretty much, they don't admit it, that it's doing all that it can, but they're kind of strung out. What they need is fiscal stimulus. So they're not going to take sides in the issue, which is playing out right now in Washington in an uncertain way, but they are going to be definitely pushing for more stimulus. And what's unfortunate about this, and we saw this very clearly in the Canadian employment numbers, is that the low-income group is the ones suffering from the COVID situation. They're the ones have lost their jobs. 78%, or that's more than 20%, have lost their jobs. These are Canadian numbers. And these two employment reports have been moving in line together, the U.S. and Canada. And 98% of middle and higher income still have their jobs. So the people who can least afford it are the ones that are getting clobbered right now. So there's going to have to be some kind of the North, however much Canada is considered to be a social utopia, it's not proving itself in this instance at all. So there has to be some kind of a safety net here if we want to keep, the structure of our, I don't want to overstate things, but our social structure together. So.
Okay, I'm going to ask you in terms of the hits so far. What's the expectation for second quarter US GDP?
It's pretty frightening. The Econoday consensus, let me just check what the latest numbers is. I'm going here on the calendar. The latest number updated is minus 35% annualized rate of contraction. And we've been talking Jeremy, over the last couple months. Well, what do you think second quarter is going to do? And I don't know.
Yeah.
And your side is more like in the 10% or the low double digit range. Well, 35% is not low double
Well,
digits.
I've just got to mention there the double-digit ranges you're talking about. This is quarter on quarter. You're talking annualized rates, of course. In Europe, it's just quoted as a straight quarter on quarter. So, for example, the Eurozone call at the moment, so that will be out on Friday. That's down 11.2% quarter on quarter. So if you annualize that, you're talking what? Well, roughly speaking, minus 40%.
So it's about the same. What do you have a year-on-year expectation for that?
Let's have a look off the top. I haven't at the moment. Let me have a look. But while I look for that, I'll just tell you that in terms of the components, I think we touched on this last week, which countries are likely to perform the worst.
Yeah.
Well, again, I mean, Italy and Spain, where are they? I mean, they're expected to be down about 14%. This is quarter on quarter in Italy. Spain, although we don't cover that specifically, that's expected to be off the best part of 16% or so.
So that's even worse. Yeah.
So we are really talking some pretty terrible numbers here. Let's have a look in terms of the year-on-year rate for the Eurozone. So that is down or just shy of 14%, 14% on the year.
So that's not bad.
It's not bad. I mean, let's be honest. If you can say down 14% on a year for total output is not a bad number. It really tells you about the state of affairs in the world, doesn't it?
Yeah. Well,
the
consumer, and we have a consensus for the consumer spending component, which is the bulk of the report, is 33% annualized contraction. And that included, and these predictions include what seemed to be a pretty favorable June, and for retail sales, a favorable May as well. The manufacturing sector never really contributed much, but residential spending has been okay. But in any case, these are, I think for the markets and everyone that these will be kind of academic when they come out on Thursday. I think probably the Fed's assessment of immediate conditions will have probably a greater impact, and it may take a day because those come out on Wednesday afternoon, and it may take a day for everyone to digest it. So that the assessment of the Federal Reserve's Wednesday move may actually be more important for Thursday's markets than the actual GDP number, but that's just speculation.
No, it's interesting. Particularly, we talked earlier about the idea that perhaps some of the expectations components of the the more up-to-date figures, which I think, as you say, probably the market's going to be more interested in really, because we know the second quarter is going to be bad. It's just how bad. We're getting a similar, well, it's early days yet, but similar sort of pattern or early evidence of it in Europe as well. So certainly the July consumer confidence figures, the flash numbers out of the European Commission, suggested that the recovery we've had in household sentiment may be starting to flatten out. In the UK, really, there's been no significant improvement in consumer confidence there either. So although, as you mentioned from your side, in Europe on the whole, if anything, retail sales have tended to probably recover over the last couple of months or so rather more sharply than most of the forecasters anticipated. And that includes for central banks as well. But that may just simply reflect pent-up demand from the lockdown, and now people are starting to look around and virtually you can't pick up a newspaper or look at a TV screen in the UK or continental Europe without it talking about, well, look, such and such a retail sector has just lost another X thousand jobs. Somebody else has just shed employment by another X thousand, and it is most of the kind of the media headlines are all pretty gloomy, and so it's going to be interesting whether that actually translates into perhaps consumer confidence starting to struggle again. And
well, so we saw that last week here with the weekly jobless claims for the first time in 4 months. They didn't go down; they went up, and they seem to be stabilizing at about 1.5 million first-time claims a week. So that means businesses are going out of businesses. And even though there are Amazon or whatever is hiring, of course, but there's a lot of people in the old brick and mortar who are being, cast aside. And we also had durable goods yesterday, which offered we were talking about retail sales. They popped up here to actually match their February level in total. But in contrast to that, we have durable goods orders, which are a measure for the manufacturing sector. And here, airlines are going out of business. Boeing isn't doing so great. And cancellations, we've had 3 or 4 months, and you don't normally see cancellations in new orders. So they pull them out. And so we've had 3 contractions of the last 4 months in aircraft orders. And unlike retail spending, durable goods orders are down 19%. February's 19% above where we are now. So that's still a huge gap. And that's I don't know how you want to look at that or how you want to annualize that, but that is a very significant amount of trouble.
It is. No, it's interesting. I mean, that's the orders data over there. We don't really tend to have too much which is compatible coming out of Europe. But the markets do place a lot of weight on the orders components of these PMI numbers. And when you're looking at those, as far as July was concerned, or at least the flash data anyway, we saw by the looks, generally speaking, we saw positive growth in most of the Eurozone bloc and the UK. But we're talking about almost minimal growth. And we're talking about minimal growth from having seen the bottom fall out of the orders book over the previous several months. So even if things are starting to turn around a little bit, it really doesn't seem to be, particularly over here anyway, as if there's going to be sufficient demand already in the pipeline to ensure that output can actually start moving back in any kind of significant way towards where it used to be. I suppose there's not so much talked about inflation these days, but something just for our listeners to be aware of. On Friday, we'll get the flash HICP, as the Eurozone likes to call it, so their harmonised index consumer prices. Will be out for July. That's expected to come in at 0.2% on the headline basis, so year on year that'd be down from 0.3%, and the core at 0.7 down from 0.8%. If anything, I should mention, was probably downside risk to this, and this revolves around Germany, where folks may remember we talked about they cut their VAT rate at the beginning of July and reduced it by 3 percentage points. So the question here is, of course, how much a reduction in VAT to shops actually pass on to the consumer. If they were to pass all of it on, then in theory we could see German inflation going from 0.9% at the moment into negative territory. And of course the HICP includes Germany. It's almost 30% of it or so, and what happens to Germany is going to very much impact what happens to the Eurozone inflation rate as well. We'll get the German numbers out on Thursday, so as usual a day in advance of the overall Eurozone picture, but it's possible, say, if we were to see all the benefits of the VAT cut being passed on to consumers, that German inflation could actually go negative, and if that were to be the case, there'd be a good chance that Eurozone could have it as well.
And the ECB is still keeping their 2%. They haven't talked about.
Well, this is it. I mean, they're due to, if people remember, that we talked about back end of last year, that, I mean, this year, the ECB was supposed to be having this massive structural review of what monetary policy really stands for, what it's supposed to be doing, what it's aiming for, and everything else. Then along came the coronavirus and it was shelved. Well, they're due to resume it in the second half of this year, with the results expected now. Well, originally they were hoped to be out kind of by the end of 2020. They're now tentatively sort of expected around about the middle of next year, or perhaps a little bit later. But one of the part and parcel of that review, of course, was going to be, look, do we maintain this so-called near 2% inflation target? As things currently stand, yes, I mean, this near 2% is their goal, and policy is supposed to be set with a view to making sure that HIC inflation moves up towards that level, over the medium term. So really, anything which suggests, on a temporary basis, that inflation is going to go down isn't good news for them. And it's particularly bad news because although this cut in VAT is only supposed to be temporary in Germany, currently it's scheduled to be reversed once we get to the beginning of next year. But if it does lead to negative inflation rates, let's say over several months, of course, it could reduce down even further inflation expectations and put downside pressure on wages, etc., which will make the idea of attaining, this near 2% inflation target, even more of a pipe dream than it appeared to be at the moment. What else have I got to say? Not too much really from my side, I think. I suppose I should just mention in the UK, we did get a very strong pickup in June retail sales. That was announced, where are we, in the last few days, up almost 14% on the month. And these are volume figures, by the way. So in most of European sales figures are all done in volumes rather than including prices, so nominal figures as your side of the water. And it actually means that if you strip auto fuel out of this now, UK retail sales, somewhat amazingly, I must say, are back above where they were before the lockdown was introduced in March time, which is a remarkable recovery, I must say. Having said which, if you believe what Confederation of British Industry were saying over here
well,
earlier
yes,
today,
I was going to ask. Now that one came out today. The retail sales came out last week. They obviously retail sales tracks retail sales. What does distributive trade track?
Well, distributive trades is broken down into things like retail sales itself, which is the main body, but it also calls wholesale sales as well. So it looks at the broader picture of overall sales rather than just the retail sector. But as far as the markets are concerned, when you look at this headline orders book, or sorry, purchasing index, it's very much it's the retail side that they tend to concentrate upon.
And that's data for July.
And that's data for July, so that's more up to date than we've had so far, in terms of the the hardline figures. And that suggested, okay, we actually had a positive reading, suggests that sales have finally gone back into positive growth territory. That's on a year-on-year basis. But when you look at the breakdowns of this, there's still some significant pockets of weakness. And the CBI itself, you can tell, is extremely worried. Again, it comes back down to fiscal policy. What's going to happen to the level of demand once some of these support packages we have coming out from governments all around the world at the moment, if they are start to be phased out in the course of the next few months, what's that going to do to disposable income and hence demand and so on? So it's interesting, although we've actually have had from the retail side some surprisingly strong June figures, figures for June and indeed for May, there's still an underlying concern about what rising unemployment is going to do to demand once we get over the next 2 or 3 months or so.
Mm-hmm.
What else? Any else from your side? I think.
Well, I just want to throw
numbers,
in. We were kind of talking about it before the broadcast, but it was about the Florida Marlins, the baseball team. They caught a cluster within the baseball team. And now this, we've been wanting to watch a baseball game just to unwind. and now it's a nerve-wracking thing. So and that is kind of out of the blue, and they were supposed to be careful and all this other stuff, but if that doesn't that can't possibly be good for consumer confidence, and that wasn't, of course, reflected in today's consumer confidence reading, because that it takes a week or so before these numbers can get published. But that was an unfortunate subheaders, to what's going on over here.
Yeah, I think that's exactly right. And it's true of everywhere. I mean, looking around the world now, although, it does seem that the US has probably got the worst of it at the moment. You can look at Beijing, where they've had new clusters there and they've had some fresh lockdowns coming in. Parts of Spain is the same sort of thing. And indeed, just looking at Spain, as of yesterday, the UK government was getting an awful lot of flack from the Spanish government because it reintroduced quarantine for anyone coming in out of Spain travelling into the UK following a rise in some of the Spanish numbers. So effectively, if you're traveling out of Spain into the UK now, you have to self-quarantine for 2 weeks. And that's that means effectively for the UK tourist industry, a big chunk of which goes into Spain. Effectively, no one's going to go on holiday to Spain until it's lifted. And it's going to be a major hit to an industry which has been hit massively already because of the fact that people are very cautious now about going overseas on holiday, even if they can do in the first place.
Well, let's talk about the sporting industry for a minute. Have you seen football has been revived there? For a month or two at least, right? And have there been anything comparable to what we've seen here in baseball?
Football is back in the UK, yes, but again, behind closed doors. And the same, more importantly, for cricket fans of the world, and good for them, the Test match cricket as well, which I should point out, England beat the West Indies today, rah, rah, rah. But yeah, generally speaking, sport is back in UK and in Europe, but by and large, it's behind closed doors still. There have been some spotty, if that's the right expression, incidents of players becoming infected and having implications then for localized shutdowns of a football club, whatever it may be. But you can tell, such has been a hit to sport and hence the economy, that governments are desperate to try and get sport back in some shape or form. But it's how you manage the whole process of, do you get it back and put all the fans in just in one big lump, and all of a sudden you end up with a second wave, which even more devastating than the first one, or what? It's obviously something which is extremely difficult to manage. Okay, right. Well, hooray for sport, I suppose. Hopefully we still get some of it on the way back. But I guess we'll end it there for today then. So it's going to be a week in which, most of the big economic numbers are going to look truly awful. So we'll need to see a significant and sustained improvement in the data going forward if the unprecedented wave of global policy easings we've already seen delivered in 2020 is not to be extended still further. From Mark and myself, thanks as ever for listening. We'll be back next week when we'll be joined by our Asian expert, Brian Jackson. In the meantime, keep up to date with all the key market moving data and events in Econoday's global economic calendar. Stay safe and we'll see you next time. Bye for now.